Hi, this is Sally's Book Club, bringing you the best global books every day. Today we're exploring the Essays of Warren Buffett, Lessons for Corporate America. The author is Warren Buffett, chairman of Berkshire Hathaway and renowned investor, business philosopher. Ranked pound 2 on Forbes' 2017 Global Billionaires list. Buffett built his $75.6 billion fortune through investments, a true master investor. Buffett writes annual letters to Berkshire shareholders, detailing operations, investments, and philosophies. His market perspectives. Professor Cunningham later distilled Buffett's investment philosophy from these letters, organizing them by theme, hence this book we're discussing. This book offers two key values. First, it's an investment classic. Buffett built upon Benjamin Graham's value investing principles while developing his own unique methodology. These insights are crystallized in this collection of letters. 4. Understanding value investing and Buffett's approach. This book is the perfect starting point. Second, it's also a business classic covering corporate governance, M&A, financial evaluation, and more. Business and investment are interconnected. Deep business understanding enables successful investing. For developing sharp business acumen, this book offers profound insights. Now, I'll explore the book's essence through the investment business lens, focusing on two key questions. First, what is value investing? Second, what companies does Buffett target? Let's start with value investing. Buffett has articulated this concept brilliantly across different eras. The simplest definition: buy wonderful companies when they are undervalued. That's Buffett's value investing. When a quality company's stock trades below intrinsic value with significant margin of safety, that's the sweet spot. Buffett believes market prices eventually reflect true company value. He has a classic analogy. The market is a voting machine, short term, where stock prices reflect investor preferences. But long term, the market becomes a weighing machine. Prices ultimately reflect actual company value. This reveals value investment's two prerequisites: 1, quality companies, 2, undervaluation. A common mistake is focusing on one while neglecting the other. Some investors chase undervalued prices but ignore company quality, essentially bargain hunting among trash stocks. Cheap prices can be tempting, making investors overlook poor fundamentals. Buffett calls these cigar butt investments, like discarded cigarette stubs with minimal remaining value. You might get one last puff, but it's ultimately worthless. Buffett considers this approach laughable, unless you're liquidating company assets. Struggling companies breed endless problems. Apparent bargains often conceal negative assets. There's a vivid analogy in the book. Finding one cockroach in the kitchen means there are many more hidden. Bad companies always have more issues than visible. Resisting bargain impulses is harder than it sounds. Buffett himself learned this through painful experiences. He lost years on Baltimore department store stocks bought cheaply, barely breaking even after 3 years. Berkshire Hathaway itself originated as a failing Massachusetts textile mill. Buffett succumbed to its apparent cheapness despite industry decline. Berkshire's $7.50 stock price seemed cheap versus $13 book value, but hidden liabilities outweighed apparent discounts. So, in Buffett's eyes, it was a perfect cigar butt. Buffett planned to acquire Berkshire, liquidate its assets piece by piece, then shut it down completely. This seemed like risk-free arbitrage, a guaranteed profit. But liquidation proved difficult due to shareholder opposition and union resistance. It also damaged local communities and drew public criticism.
Worse, technological advances rendered factory equipment nearly worthless.
The $13 book value per share became $8 in actual sales.
Buffett became trapped in textile operations, endlessly reinvesting with no returns.
What began as arbitrage turned Buffett into majority shareholder. Later transformation into financial conglomerate is another story. The Berkshire investment deeply impacted Buffett.
He repeatedly called this his biggest mistake.
This experience ended Buffett's cigar butt investing permanently.
Even Buffett could get stuck in bad companies. What chance do ordinary investors have?
Average investors can't realistically buy and liquidate companies. Low stock price or PE ratio doesn't automatically mean good value. The crucial question, why is the stock cheap? Is this actually a quality company?
Is it trapped in quicksand?
Another mistake, buying great companies at inflated prices. Buffett warns this eliminates margin of safety. Even great companies bought too high face. 2 scenarios. First, holding for years until growth catches up with price.
Second, immediate price correction through steep decline. The risks remain substantial.
Consider this extreme case. Buffett made 7x returns on PetroChina while a share investors suffered heavy losses. The difference lies in entry price. Buffett accumulated 2.3 billion PetroChina 8 shares between 2000–2003. His average entry price was $1.60 per share. By July 2007, 8 shares reached 12 Hong Kong dollars. Buffett began selling as prices kept rising. When exiting completely in October at 18 Hong Kong dollars, shares still climbed post-sale.
This 5-year investment yielded over 700% returns.
1 month later, PetroChina shares debuted at 48 Chinese yuan and 60 cents on November 5, 2007. Chinese investors bought into Asia's most profitable company narrative.
5 years later, a shares plunged 82%. Why such disparity?
The answer. Buffett bought at 1 Hong Kong dollar and 60 cents, considering both quality and price. A share buyers at 48 Chinese yuan and 60 cents ignored extreme overvaluation. Buffett learned from Graham, buy quality at discounted prices.
His famous quote, whether socks or stocks. I like buying quality merchandise when it's discounted.
Buffett believes Mr. Market constantly offers buying opportunities. The book shares Graham's Mr. Market parable. Graham taught using Zen-like parables similar to Chinese Chan Buddhism. The story goes like this. Mr. Market visits daily, offering stock prices, asking to buy, sell. This emotional character alternates between extreme optimism,
Fearing you'll buy shares, he quotes absurdly high prices, then plunges into pessimism, seeing only corporate doom. He's desperate to dump the hot potato onto you, hence the ridiculously low quotes.
Buffett uses this story to emphasize timing, capitalize on market pessimism to buy quality stocks cheap. To summarize value investing, buy wonderful companies when undervalued. Now to our second question. What companies does Buffett consider wonderful? From the book, we distilled two crucial criteria. 1. Comprehensible businesses. 2. Strong long-term prospects. Let's examine each. First, criterion. Businesses, you understand? Buffett's circle of competence theory. No one understands all companies. Investors' knowledge and experience define their analytical boundaries. These factors create a personal competence circle limiting investment scope. Buffett insists, never venture beyond your competence boundaries. Simply put, avoid unfamiliar industries or complex businesses. This explains Buffett's historical avoidance of tech stocks, too fast-changing. Competence circles develop through life, experiences, and education. Buffett's initial competence came from his father's expertise. His father, an Omaha stockbroker, specialized in municipal bonds. From him, Buffett learned about stable government-backed investments. Buffett's first stock purchase. 3 shares of Citi's Service Preferred Stock. Graham's value investing philosophy later expanded Buffett's competence circle. He learned to identify undervalued stocks through financial analysis. Essentially, cigar butt picking. After studying under Graham, Buffett's strategy mainly involved repetitive cigar butt investments. Buffett's competence circle kept expanding. Today's Berkshire Hathaway spans insurance, banking, energy, railroads, etc. Their portfolio includes manufacturing, retail, media, and various niche industries. How did Buffett expand his competence? 2 methods. First, extensive reading. Buffett devoured all books in his grandfather's library. By age 15, he once read hundreds of horse racing books during a betting phase. In high school, he consumed every investment book at the public library, including Graham's The Intelligent Investor. At Columbia University, he studied financial classics and industry manuals like Moody's and S&P. His daily routine in Omaha always began with reading financial publications. He read diverse materials from the Wall Street Journal to niche trade magazines. This voracious reading built his business acumen and data sensitivity. Second method. Learning from industry experts. He absorbed wisdom from Graham, Fisher, Lynch, and Munger. Buffett actively sought insights from corporate executives. He frequently visited companies and hosted business leaders in Omaha. He enjoys social gatherings and networking events with professionals. To improve social skills, Buffett took Dale Carnegie courses. His 1952 Carnegie Public Speaking Certificate still hangs in his office. Buffett considered selling American Express stock due to Visa competition. But he respected CEO Harvey Golub's leadership. During this indecision, Buffett met Hertz CEO Frank Olson on a Maine golf course. From the first hole, Buffett quizzed Olson about credit card industry insights. Olson explained Amex's brand legacy compared to Visa, MasterCard. Amex cultivated premium clientele. These factors maintained Amex's competitive edge. Postgame. Buffett became bullish. Amex became an iconic investment. Business leaders continually expanded Buffett's competence circle. Coca-Cola's Don Quixote and Microsoft's Bill Gates broadened his industry understanding. Buffett's expanding competence mirrored Berkshire's growth over 6 decades. This concludes our first criterion: invest in comprehensible businesses. Stay within your expertise to grasp business models and future potential. If you can't understand it, don't invest. Second criterion: strong long-term prospects. What defines these companies? Buffett seeks companies with economic moats, durable competitive advantages. These competitive advantages are relatively simple and stable. Buffett's economic moat concept can be understood from 2 perspectives. First, the moat creates competitive barriers maintaining industry leadership. Second, it enables premium pricing power and sustainable excess profits. Take Quaikao Mutai, its monopoly on unique geographical resources, distinct production methods, and national liquor brand form its moat. These factors make Mutai unchallengeable in the baijiu industry. This dominance grants ultimate pricing power. Mutai sets industry standards. Tencent's moat lies in massive user base and engagement, unshakable in social media. Apple's innovation and brand moat capture 80% of smartphone profits. It avoids price wars with Android manufacturers. Let's examine 2 Buffett case studies. First, Coca-Cola's moat comes from iconic brand and marketing prowess. Simple product, straightforward model, clear competitive edge. Beverage demand remains constant, unlikely to vanish for centuries. Coke secured consumer mind share since early 1900s as flavor benchmark. Its value endures as long as carbonated drinks exist. As cultural ambassador, Coke's global dominance parallels U.S. soft power. This moat remains effective decade after decade. Despite diversifying with Fanta, Sprite, and juice acquisitions, Coke's core beverage focus maintains its competitive advantages. Buffett famously said, "Give me $100 billion to dethrone Coke. I'd return it, admitting impossibility." Since the 1930s, analysts annually predicted Coke's market saturation. Buffett saw its moat ensure longevity, buying heavily during 1988's price slump. By 1994, Buffett owned 7.8% of Coke with $1.3 billion investment. He became Coca-Cola's chairman in 1989. By mid-2012, these shares were worth $15.6 billion. Now consider Buffett's other favorite, Gillette. Gillette dominated male grooming with razor blades, essential recurring purchases. Its moat, Intio business model, and R&D capabilities. Gillette invented disposable razor blades in 1895. Buffett called this revolutionary, creating recurring blade purchases. Gillette maintained strong product innovation. Over a century, it launched industry firsts, twin blades, pivoting heads, Mach 3, This moat allowed premium pricing and high margins. Consumers accepted 25% price premiums for superior razors. Buffett invested $600 million in convertible preferred shares in 1989. By 2004, his Gillette stake reached $4.3 billion. Procter & Gamble's 2005 acquisition boosted the stake to $5 billion. Identifying moats sounds simple, but requires deep analysis. Buffett shared a key technique for ordinary investors. Stock analysis is detective work. Uncover how companies make money, their hidden value, then assess if they possess durable moats. Buffett's first detective work began at Columbia University, when he learned his mentor Graham chaired an insurance company holding 55% stake. He wondered why GEICO captivated his teacher, sparking his investigation. Young Buffett boarded a train to Washington, bluffing past security to meet BP Lorimer Davidson using Graham's name. The seasoned executive initially dismissed the brash student, but relented due to Graham's prestige. What began as 10 minutes turned into 4 hours as Buffett's acumen impressed Davidson. Davidson revealed GEICO's moat: ultra-low-cost auto insurance through revolutionary distribution. GEICO achieved cost leadership via mail-order marketing, eliminating expensive brokers. They minimized risk by targeting government employees, responsible drivers with stable incomes. Buffett invested heavily within 48 hours, evangelizing GEICO to everyone. This investigation unveiled insurance's golden goose float. Insurers invest upfront premiums, creating low-cost capital, a concept shaping Buffett's career. In exceptional insurance cases, decades may separate premium collection from claim potence. Annual premium intake and claim payments fluctuate, but retained funds remain relatively stable. Larger insurers hold more low-cost capital. Buffett recognized this key insight early. Massive capital reserves enable buying undervalued stocks during market lows. Low-cost stable capital allows long-term holdings without liquidity. Concerns a revolutionary realization for Buffett. Insurers became Berkshire's foundation. GEICO is now fully owned by Berkshire Hathaway. Acquisitions like National Indemnity, the world's largest P&C insurer by net worth, expanded this strategy. Insurance operations continuously fuel Berkshire's investment engine, enabling major acquisitions during downturns.
Crucial note: moats are permanent. Regulatory changes, technological shifts, and consumer trends can erode advantages.
Continuous monitoring is essential. This concludes our second criterion analysis. Recalling both criteria. 1. Invest within your competence circle. Understand the business thoroughly. Avoid investments beyond your comprehension. R. Seek durable moats. 特许权, monopolies brand advantages, cost to leadership, innovative models. Identifying moats requires detective-like analysis of business fundamentals. Finally, Buffett's concentrated holding strategy challenges traditional diversification wisdom. Buffett doesn't completely oppose diversification. He believes inexperienced investors should diversify. But if you truly understand companies with moats trading at fair prices, diversification becomes unnecessary. Concentrate on your best ideas. Buffett's famous advice: put all eggs in one basket, then watch that basket. His greatest successes came from concentrated bets on exceptional opportunities. Economist Keynes shared similar views. Keynes advocated heavy investments in understood businesses with trusted management. Blind diversification across unknown companies doesn't reduce real risk. Human knowledge and experience have natural limits. Thus, only 2-3 companies typically deserve full conviction at any time. This concludes our discussion. Let's recap 3 key takeaways. 1. Buy wonderful companies when undervalued. 2. Selection criteria. Comprehensible business plus durable competitive advantage. 3. Concentration principle. Heavy positions in few winners. Buffett. Expecting stock gains overnight is foolish. Investing is a marathon of continuous value discovery. Buffett's wisdom offers timeless lessons for investors. This concludes our analysis of Buffett's shareholder letters. Keynotes below. See you tomorrow.